if you're looking at the raw market data right now, you get two completely contradictory signals.
Completely. On one side, a major conflict is winding down.
Which should be a huge risk-off event, right? Should signal stability.
Exactly. A stampede back into stable equities. But then you look at gold.
The ultimate indicator of distrust. And it's trading. Just spitting distance from its all-time high? The signals are mutually exclusive.
It's extreme cognitive dissonance in the financial system. You have this major peace agreement, and gold is just sitting there, stubbornly firm at $43.30 per ounce.
And we can see this is structural, not just some temporary noise. Look at oil. We saw that rapid, almost knee-jerk spike.
To 112 a barrel after the action in Venezuela.
Right, but the physical supply fundamentals, they corrected that pretty quickly. What's left behind, though, is the volatility itself. That swing is now fixed into the market. It's a new permanent risk premium.
And all the while, gold is actively interpreting the so-called peace, not as stability, but as a clear signal of U.S. isolationism. And more importantly, that its fiscal deficit is now structurally out of control.
It's pricing in distrust, not just fear.
Distrust in the dollar itself.
This is neural pulse. Let's analyze.
This whole structural shift in U.S. focus, it's the engine driving all of this market confusion. We have to start where the pivot actually began.
In Europe, with the decision to dramatically reduce commitment there, the timing on that was critical.
Very. We saw the outcome of that January 4th meeting, the one between key U.S. players and President Zelensky in Mar-a-Lago.
The speed of that agreement was just stunning.
The reports were definitive. We learned, 90% of the overall peace plan was finalized, and critically, 100% agreement on the security guarantees.
It looks like the U.S. executing what you'd have to call an honorable withdrawal, right? Wrapping up a proxy war.
That's the frame. But the speed. The speed raises a huge strategic question.
Why the rush? I mean, couldn't the U.S. have sustained a long-term commitment in Europe while managing other fronts?
It's purely about logistics and strategic concentration. You can't separate this European development from what happened the day before.
Operation Southern Spear.
The detention of President Maduro in Venezuela on January 3rd, it's all connected.
So the U.S. effectively just traded one theater for another.
Precisely. They cannot logistically maintain kinetic military action in multiple distant theaters while also pivoting resources to their own backyard, South America.
And preparing for the Pacific.
Right. What's widely seen as the inevitable, much larger conflict in the Pacific. So that direct intervention in Venezuela, which is a massive resource commitment, it required an immediate dramatic reduction in Europe. It was a cold, calculated logistical trade-off, a strategic divorce.
And that divorce is creating this paradox.
Yeah.
Usually the end of a conflict gives you a huge peace dividend.
Mm-hmm. Money spent on war is freed up for consumption, investment. It fuels growth.
But instead, we're seeing instability. European defense stocks, the euro itself. So why is peace suddenly bad for the euro?
It all stems from the fine print, from those new security guarantees. European countries are afraid, and I think rightly so, that these guarantees will not contain the one thing they truly rely on.
An automatic intervention clause, like NATO's Article 5.
Exactly. So if the U.S. is withdrawing, Europe is suddenly forced into this immediate mandatory rearmament.
And that peace dividend instantly becomes a massive national liability.
Absolutely. The money that should have boosted consumption is now earmarked for defense budgets. So that translates directly into higher debt for countries like Germany and France, and potentially a swift end to the fragile fiscal discipline they've struggled to maintain.
So stability is now a liability, financed through debt.
Correct. And the European Central Bank will face immense political pressure to buy up those domestic defense bonds, to prioritize stability over inflation control. It's fundamentally inflationary for the Eurozone. That's why the euro is under pressure even as the war winds down.
And the energy situation doesn't help. Any relief you might expect is pretty minimal.
Right. A Ukraine ceasefire might suggest Russian resources return to the market, but the U.S. priority now is maintaining control over Venezuelan crude.
So we have to assume that Russian sanction relief will be limited, regardless of any deal.
And that continued political supply adjustment will keep energy prices structurally high. So the cost of fuel, the cost of defense, the cost of debt, it all just goes up for Europe.
So the takeaway is clear. The U.S. closed the European front to free up enormous resources. The question is, where are they going?
And this brings us right to the financial pivot. When military strategy changes, the money always moves first.
Let's go back to the resilience of gold. It's holding near 43.30 despite this major risk-off news. And this isn't just noise. The forward guidance is there.
Yeah, you have major houses like JP Morgan,
You know,
UBS.
they're looking at prices reaching $5,000 by Q4 2026. Long-term targets hitting 6,000.
We really need to retire that old adage, that gold is just a crisis hedge. That's a dated understanding.
So it's not driven by the fear of war anymore.
Not primarily, no. It is now structurally driven by distrust in currency.
And that distrust is fueled by what, specifically?
The structural expansion of the U.S. fiscal deficit, I mean, just look at the drivers. You've got planned domestic tax cuts, looming tariff increases, and now the growing, very visible military costs in South America.
The U.S. is paying for this pivot by borrowing.
Massive amounts. The deficit isn't shrinking, it's accelerating. And that erodes the underlying confidence in the dollar's long-term value.
Which brings us to the really counterintuitive part. We're seeing gold, a non-yielding asset, being bought heavily, even when real interest rates are positive. The 10-year yield is sitting at, what, 4.17%?
Right. Why buy gold when you can get a guaranteed 4% on safe U.S. debt?
It's a critical signal.
It implies two things. First, investors believe current rates are just fundamentally insufficient to contain the inflation that this deficit spending will cause. And second, and this is maybe more worrying, they believe U.S. sovereign debt itself has become a political risk asset.
It's no longer the universally safe haven.
When you see smart money preferring a physical, non-yielding rock over a government bond, the fundamental rules of the game have changed.
And we're seeing this reflected in institutional behavior, not just private capital.
Precisely. It signals a definitive shift toward asset multipolarity. The biggest buyers of gold right now are central banks.
China, Russia, the global south.
Averaging a phenomenal 585 tons per quarter. This isn't speculation. This is a permanent defensive maneuver against the perceived weaponization of the dollar.
So they learned their lesson from the Russian sanctions, from the Venezuelan asset freeze.
Absolutely. The message is crystal clear. Dependence on the dollar as your sole reserve currency is now a direct geopolitical risk. For a lot of these actors, not holding real assets like gold is no longer a missed opportunity. It's a potential failure of fiduciary duty.
A profound structural shift from a dollar monopoly to asset multipolarity.
And this deep financial pivot, this move away from the dollar, it perfectly mirrors the military pivot, which is now squarely focused on the Indo-Pacific.
Let's look at the hard proof of that military prioritization, where those resources freed from Europe have actually gone.
Okay.
We can detail the current U.S. military posture. China's Justice Mission 2025 exercise, that big blockade drill, it ended December 30th. But crucially, the U.S. Navy's two-carrier posture remains fully operational.
Both the Abraham Lincoln and the George Washington.
Still deployed in the South China Sea and the Philippine Sea.
And maintaining two carrier groups in that specific region. That is the proof of the European trade-off. A carrier strike group is a massive, expensive logistical effort. That's effort directly subtracted from Europe.
And it's not just the carriers. We're also noting the addition of the assault ship Tripoli, loaded with F-35s. This is a heavy commitment.
It's the visible physical deterrence the U.S. needs to assert its interests. China just demonstrated its capability to cut off Taiwan's LNG imports.
So the U.S. response has to be physical and not just rhetorical.
Right. The posture is focused on protecting two core U.S. interests, the semiconductor supply chain and the energy shipping lines that flow through that region.
What's fascinating here, though, is the disconnect you see on the surface of the logistics market. If the risk is this high, shipping prices should be through the roof.
But they're not.
The Shanghai Container Freight Index is basically level, hovering around 1,656 points. It seems like the surface market is just ignoring the Taiwan risk.
And that calm surface is a dangerous illusion. It's why just looking at the top-line numbers can mislead you. You have to look at the hidden factor.
The insurance market.
Exactly. We've seen credible reports that war risk premiums for any ships transiting the Taiwan Strait have spiked to several times their normal cost.
So the risk isn't in the freight rate itself, it's hidden in the cost to insure the vessel and the cargo.
Precisely. This unacknowledged increase is a structural, hidden inflationary factor impacting every global supply chain, but you don't see it in that headline index. Someone is paying that massive extra cost, and eventually that someone is the consumer.
And we're seeing financial spillover into the region, specifically Japan. The Bank of Japan hiked rates in December to try and stabilize, but this persistent Taiwan risk is creating dual pressure on the yen.
It's a chaotic push-pull. On one side, risk pushes traders into the dollar, which weakens the yen. But on the other, the same risk might cause Japanese companies to repatriate capital, strengthening the yen,
leading to maximum currency volatility.
which makes life incredibly unpredictable for Japanese exporters and manufacturers.
But the ultimate consequence for global business has to be the status of the Taiwan Strait itself.
It's fundamentally transitioned. It is no longer a region of assured freedom of navigation. It's now what you'd have to call a quasi-war zone. We're seeing constant visible presence from both the China Coast Guard and the U.S. Navy.
So if that shipping route is permanently questionable,
Mm-hmm.
the whole operational premise for modern manufacturing is shattered.
Absolutely. You can no longer rely on those efficient, capital-light, just-in-time supply chain models,
Because the route could be severed at any moment.
leaving a factory idle, costing millions. So companies have to revert to just-in-case inventory stacking, holding more inventory for longer in more secure locations.
Which is a severe deterioration of manufacturing cash flow globally. It ties up capital that could be used for R&D. It's a permanent drag on productivity.
So it's time for the final synthesis. Let's pull these threads together. What does this massive geopolitical shift actually mean for the decision makers listening to us right now?
Well, the world hasn't become more peaceful. The battlefield has simply moved to areas of direct existential U.S. interest.
That's the new global reality. The U.S. is rapidly wrapping up the proxy war in Europe and moving all available resources, kinetic and financial, to two specific areas, Venezuela and Taiwan.
Which requires a new set of actionable warnings. First, do not sell this peace narrative you see in the headlines. It's not stability. It's a signal of American isolationist realism, a focus on domestic needs and immediate hemispheric and Pacific control.
And second, do not be misled by any temporary dips in energy prices. The underlying risks in the Middle East and Taiwan haven't gone away. You have to build your operating model to accept that $100 plus spikes are imminent and these volatile swings will recur.
And finally, a provocative thought. We have to connect this military shift to the unseen domain. Given the U.S. kinetic action we've analyzed, you have to warn against the current silence in cyberspace.
Hostile actors like Typhoon, they're preparing.
Yeah.
Asymmetrical retaliation. The invisible war.
So what's the advice?
Treat any infrastructure system failure in your operating areas not as a simple glitch. Don't assume it's a server problem. Treat every major system failure as a potential attack. Operational resilience, and especially cyber resilience, that has to be your absolute highest priority now.
Neural pulse. Clarity in a complex world. See you tomorrow.